Bitcoin is currently at a critical juncture, and you wouldn't believe what just happened in the crypto world 2 weeks ago. So on the 9th of January, 4:11 p.m. Eastern Time, the SEC, which is the Securities and Exchange Commission X account, which is formerly the Twitter account, tweeted the following. Today, the SEC grants approval for Bitcoin ETFs for listing on all registered national securities exchange. So the approved Bitcoin ETFs will subject to ongoing surveillance and compliance measure to ensure continued investor protection. Unquote. 15 minutes later, at 4:26 p.m. Eastern Time, Gary Gensler, the chairman of the SEC, tweeted with his personal account that the SEC's account was compromised and an unauthorized post was posted. So no Bitcoin exchange traded product was approved. So roughly after another 15 minutes, at 4:42 p.m. Eastern Time, the SEC's X account removed the initial post and tweeted the same message as Gary Gensler. So what a world that we're living in. And that, my friends, is probably just one of the reasons that proves that we are living in a matrix. So you know why this entire story seems unreal? Because not too long after the rumor of the Bitcoin ETF approval was squashed, the SEC furnished the official statement the very next day on the 10th of January that it was approved. So Bitcoin enthusiasts underwent this entire emotional roller coaster ride in a short span of a few days. So before I tell you what is next, most of you are probably wondering how the markets will shape up in the coming year. So Piranha Profits is hosting our live online event, Outlook 2024, this weekend, where Adam Khoo will be sharing his market outlook and opportunities for 2024. More importantly, what his game plan for how investors can potentially double their profits in this rare Goldilocks year.
So each attendees will receive a copy of his January market analysis report and also his top 8 stocks list.
So registration link is in the description box down below. So slots are limited, so do grab yours fast. Now, let's get back to the topic. So the first question that comes to mind would be, what and how does a spot BTC ETF work? So the spot Bitcoin ETF is a product that is traded on an exchange, which essentially allows any individual to gain exposure to Bitcoin and, more importantly, its price movement. So the spot ETF invests directly in Bitcoin as its underlying asset, and they store it in, hopefully, a digital vault, making it a plain vanilla product that is very secured, rather than a conventional complicated derivative underneath it, like a futures or even an options contract. So the spot ETF then issues shares corresponding to the number of Bitcoin that they hold, and the ETF share price should track and reflect the prevailing market price of the underlying cryptocurrency, and in this case, the price fluctuation of Bitcoin. But the funny thing is, if it's such a simple product with no fanciful features, why would anyone in their right mind even want to buy the BTC Spot ETF? Intuitively, people interested in Bitcoin can already buy it on their own and store it on the exchange itself, or if they're afraid, they can move it out to their cold wallet offline. So why go through yet another intermediary, which is going to cost you even more money through management fees and even commission being charged by the ETF provider? So even famous personalities like Kevin O'Leary from Shark Tank said that I would never buy an ETF. Why would I pay these fees? It's completely unnecessary and they add no value to me. Unquote. So after some digging, it does seem like a BTC Spot ETF has a role to play in this financial market today. So for one, it gives it gives people who are not as attuned to the crypto space a headache-free way to get exposure to Bitcoin via the apps that they are already familiar with without the need to use a separate platform. I know it's a mouthful, but it essentially reduces friction for people that are not familiar with crypto in the first place. Number 2, there are probably still many people skeptical about crypto exchanges because of a few high-profile cases like FTX. Number 3, some investors might be overwhelmed with the requirements needed to manage their crypto wallets and private keys if they wish to secure their crypto offline. So a spot ETF essentially lowers the barrier to entry into the crypto market. Some people are just willing to pay a small fee to buy this peace of mind and ease of use. However, there is still a caveat underlying this development. As the saying goes in the crypto world, not your key, not your coin. As the custody of the Bitcoin is managed by the provider and not you, you are subjected to the vulnerabilities of their system. And touch wood, if the Bitcoin under custody is hacked, I'm not too sure about the process of recovery, if any. That said, the Bitcoin ETF saw $4.6 billion worth of shares trade hands on the first day that they went live. More importantly, the Spot ETF approval can be seen by some to be a significant milestone for the Bitcoin history, well on its way to becoming a mainstream and also a legitimate investment instrument, even though it is still viewed by many professionals as risky and also speculative. So Vanguard, one of the largest investment manager and largest provider of mutual funds, made a hard stance that they have no plans to make Spot BTC ETF available on all its platforms. From a more practical perspective, the incentive of the asset management game is simple. One word, AUM, also better known as asset under management. So as most of them operate with a fee structure and a fixed percentage, the higher your AUM, the more fees that you'll be able to collect in the long term. So with the new regulatory approval, it essentially sparked great competition for market share amongst the different providers and issuers, with some even slashing the fees for their ETF well below the industry standards. So fees on the new Bitcoin ETF range from 0.2 to 1.5%, with some even offering to waive fees entirely for a certain period or a certain dollar volume of the asset. So let's not forget that they are all profit-driven companies trying to make a living as well. We are not running a charity here, and offering to waive fees entirely means that they are bearing all the overhead and fixed costs of the service. So hopefully, they are able to cultivate some level of stickiness and even loyalty amongst the users in the early stage of this Bitcoin adoption. But in my opinion, I expect a wave of consolidation to take place sometime later, as providers figure that it doesn't make any economic sense, especially if the product is very commoditized. So for myself, if I were to want to gain Bitcoin exposure via a spot ETF and have to choose between the different providers, I would opt for the one offered by BlackRock, iShares Bitcoin Trust, which is IBIT. Firstly, it's of course due to the brand recognition. So if I were to buy an ETF, I hope that they have the financial muscle to stay in business for a long time, coupled with a respectable track record. Second, I would want the fees to be managed to the lowest possible level. So it's true that many of them are offering 0% fees for the first 6 months or the first $1 billion, but in the long run, most of them offer rather competitive rates between 0.2 to 0.25%, so I'm not too concerned with what BlackRock is charging. Third, I would want it to be as liquid as possible, especially with a sizable trading volume, because it will affect the bid-ask spread. So this is a circular problem, because if there's not enough volume, there will be a very wide bid-ask spread. And if there's a very wide bid-ask spread, people will not want to trade or buy into it, therefore causing lower volume. Thus, I will be more inclined to opt into IBIT due to the brand trust and equity. Specifically, for newer crypto investors, some might be hesitant about investing in an emerging asset class and would feel more comfortable with a large, well-known issuer like BlackRock, rather than solely looking at the small difference in fees being charged here. So this then begs the question, is the BTC Spot ETF finally ready for long-term investors as an alternative asset class? So I'll try to answer this question from two different angles. Firstly, this Spot Bitcoin ETF approval will not have an immediate and sizable impact on the investment landscape because it is still a relatively small share percentage of global portfolios. But in the medium to long term, however, experts do see this as a positive development that will increase the price discovery and stability of Bitcoin. That said, cryptocurrency in today's market is still far from being stable, and this new ETF approval will not change this characteristic anytime soon. So the biggest argument for Bitcoin after this event is that there will be an increase in allocation from the institutional investors over time as it gets more legitimized. From a second perspective, as Bitcoin continues to go down this path of legitimacy, more people are buying into the story of its function as digital gold. And due to the inherent feature of scarcity, we might see that BTC continues to appreciate over the long run, as long as enough people buy into the story that it holds its perceived value. So to answer the question on whether the Bitcoin ETF is ready for long-term investors, I think the more important question is whether the buyer is ready to buy the ETF. And more importantly, what is his or her expectations when buying into this specific instrument. So the funniest thing is, At the heart of this entire Bitcoin spot ETF saga resides an important man, which is the chairman of the SEC, Gary Gensler. And this is what he has to say about Bitcoin.
Bitcoin itself, we did not approve, we do not endorse. This is a product called an exchange-traded product, a way that investors can invest in that underlying non-security commodity called Bitcoin. But yes, investors, I think, should be aware that the underlying asset is a highly speculative, volatile asset, and amongst its use cases is really for illicit activity, money laundering and sanctions and ransomware and the like. And I know that you've asked other people over the last few days, is it being used as a store of value? It's a speculative, volatile store of value. Is it being used as a payment anywhere? Are we buying cups of coffee with it? Not really. The only payment mechanism it's being used for in a primary sense is illicit activity.
So in my personal opinion, if you're managing a sizable amount of money, there might be some logical case for allocating a small percentage of your portfolio to the crypto asset class. By small, it will probably be anything under 2-3%. However, investors have to be prepared for the worst case scenario, meaning to say, if everything goes to zero from here. So as the saying goes, the key to happiness, it's low expectations. So if I look at it from an objective lens, crypto as an asset class is probably here to stay for the long term. Adoption and innovation will continue in this space. And it's really a moonshot in trying to figure out how big the crypto market will be in the next 20, 30, or even 40 years. Therefore, on a portfolio level, having a small exposure, maybe even capping it at a nominal sum, can act as some sort of an insurance policy, just in case it really 100x from here again. Possible? Yes. Probable? I really don't know. However, the baseline expectation is still that everything will go to zero. Another important nuance here is that we are talking about crypto as an asset class, and not just Bitcoin. So this is CK from Piranha Profits signing off. Till next time, keep winning.